Before the past 2 weeks, I hadn't really given Netflix much thought as an investment because of two key reasons. One, they are not producing any free cash flow. In fact, they're burning it hand over fist. And two, the company has loaded itself up with over $15 billion in debt. But upon deeply analyzing the company over the past 2 weeks, I discovered something kind of crazy. The first is that while the cash flow statement says otherwise, Netflix is producing a huge amount of free cash flow. And two, while the balance sheet says otherwise, Netflix doesn't really have that much debt or other obligations. If at this point you're wondering who is this guy and what has he done with our favorite Buffett and Munger style investor, you're not alone, because before I looked into Netflix deeply, I certainly wouldn't have been making a case for why I think it actually looks like a Buffett Munger style value investor. But what I found over the past couple of weeks is pretty compelling, and I want to share that with you today. Now, you've probably seen something about Netflix's stock this week, whether it was the 30% drop in its Q4 earnings last week or Bill Ackman's $1.1 billion investment in them this week. But after seeing those two contrasting stories, one of investors running away from Netflix as fast as possible and another of a billionaire investing into it as fast as he can, you're probably very confused about how to think about Netflix as an investment. You're definitely going to be seeing a lot about Netflix as an investment from different channels over the next few weeks, and a lot of them are going to be making some massive mistakes when assessing their cash flow and their debt. Today, I want to show you those mistakes and how you actually should be thinking about Netflix when looking at it as an investment. I love making these kind of videos where I dive into the specifics of a particular business. So if you enjoy this kind of content, the best way you can show me is by just hitting that subscribe button. Hit the notification bell if you want to be updated with notifications when I post new content. But with that said, let's jump into the video. Now, I'll give you a brief breakdown of what Netflix's business is, but we're not going to jump too deeply into the circle of competence, understanding the business side of the analysis process in this video. But Netflix is a global entertainment service. They offer a library of licensed and original produced film and TV series, and they produce that to over 220 million subscribers worldwide. And Netflix is not only in this space, they are the leader by a country mile. Disney Plus is their second rival, and they have about half, a little bit over half, as many global subscribers as Netflix has. And then far behind those two, Disney Plus and Netflix, is a bunch of other streaming services, most of which who have come online in the past couple of years. Things like HBO Max, Hulu, Paramount Plus. All of these seem to have subscribers in the range of 30 to 80 million subscribers. And Netflix's business is relatively simple. They charge those subscribers a monthly fee. At the moment, that's averaging about $11 per month. So you multiply that by 12 months, multiply it by the number of subscribers they have, which is over 200 million, and you essentially get to the revenue that Netflix is producing, which last year in 2021 was $29.7 billion. And as a Buffett-style investor, when you're looking into a company, there's a lot of other things that I'm not going to include in this video that you need to be assessing. You need to be looking at whether they have a deep competitive advantage. You need to understand the business economics of how they spend money, how they make money. You need to understand whether the management team is effective at what they're doing, at reinvesting back into the business, in this case, to invest in producing content, and other things such as their debt and cash flow, which we will be covering in today's video. And usually when it comes to assessing a business's cash flow and debt, usually you can make a pretty quick judgment about whether it's a business worth pursuing further. On the cash flow side, typically if a business does not have positive free cash flow, or at the very least positive operating cash flow consistently for 5-10 years, then it's not really worth looking into. And on the debt side, it's kind of similar. You have some key debt ratios you can apply, and if the debt far exceeds those amounts or those ratios, then you quickly move on and look for a better business. And Netflix on first glance seems to fit into the basket of businesses you would very, very quickly not want to look at. In terms of last year, 2021, free cash flow came in at negative $800 million, which is very, very negative and nowhere near positive, which is what we want to see consistently over time. And if you look back at their other years, they've been much more negative in terms of cash flow. They definitely don't have a consistent trend of positive free cash flow or even operating cash flow. But here's something to think about. Before getting to that negative free cash flow figure, they spent $18 billion on new content assets, which essentially means they're spending money primarily on the production of film and TV series that they make in their own studios, but it also includes the licensing of other content, which they used to do a lot more of, but since 2015, they've really primarily been a film studio in terms of where their expenditure is going. So the real question here is how much of that $18 billion that that they spent on producing new content is necessary just to maintain their existing subscriber base, and how much of that is driving new subscriber growth. Because of course, they need to produce new content every single year. Of course, if they stopped producing content, people would get very, very sick of the platform very quickly and would switch to another platform. So there's some level of within that 18 billion that does need to be spent on just maintaining and keeping people on the platform. But it's also fairly reasonable to argue that a significant portion, or at least some portion of that 18 billion is driving more growth in the business. Now, I'm going to make an argument in a second for why I think a good portion of that 18 billion is growth expenditure and therefore is driving growth in the business. But let's just say that you assume that the $18 billion is what's necessary just to maintain the current 222 million users that they have, or subscribers that they have on the platform. Fair enough. If that's the case, then this is a terrible business and you can stop doing your analysis there. You can just sit back and go, this company does not produce any free cash flow, which is I think what a lot of people do when they haven't really looked deeply into the business. If you think that's the case, that's fine. This would not be a great business. But if we look back at just a few years ago, it really wasn't all that long ago. They were spending $3 billion on content, $4 billion on content, and even $7 billion on content. And even then, the platform was seeing huge increases in the number of subscribers. So even when they were spending a fraction of the amount on content, their platform was expanding at a massive rate internationally, as it continues to today. So I think it's fairly reasonable to assume that at least some portion of that 18 billion is being used to drive growth of new subscribers, particularly if you think about the massive amount of expenditure they're spending on foreign films to capture new markets that wouldn't typically watch a lot of Netflix's original English content. And this is where the analysis for Netflix really lies, because depending on how you think about that 18 billion, depending on how much you think is maintenance versus driving future growth in the business, will really depend on whether you think this is a good business or a bad business. And just to give you the two ends of the extreme, if just $2 billion of that $18 billion is maintenance spending, so that's, producing a ton of films, a ton of TV shows, and that keeps people on the platform, and then the remaining 16 billion is really free cash flow that they're just deciding to reinvest back into new content to grow the platform, to compound cash flows, as we like with businesses. We prefer businesses that have the opportunity to reinvest back into the business to grow, rather than just spitting that cash out to us, because if they pay that 16 billion out to us, we have to go find a new investment for that money. I would rather, if they have the opportunity within the business, to reinvest it back into new content in this case. If that's the case and they have 16 billion in free cash flow, then the company's at a 10% cash flow yield, which is insanely cheap for a business growing at the rate they're growing, with the opportunity they have to expand internationally. And on top of that, if you think about this, with their current subscriber base, even if we don't include any more future growth, just a $1 increase in the monthly price of Netflix would add another $2.5 billion of incremental cash flow on top, meaning $1 charged extra, which is what they recently just did, and they're rolling out over the next quarter, would add, let's say, from that 16 billion to turn it into 18.5 billion in free cash flow. And if you follow that down for like 5 years, you're very, very quickly getting to a business that has an extremely high cash flow yield. Now, that's the good side. That's the one end of the absolute extreme where most of their spending on content is going towards growth of the business. What if we flip it the other way? What if 16 billion is what is necessary just to maintain people on the platform? So you could argue that over time, people demand more and more content, better content, so they have to actually up their spending over time. They actually have to produce more content. They can't produce the same 200 movies and TV series every year. They have to do 200, then 210 or 250 over time. And let's say the 16 billion is maintenance and only 2 billion is free cash flow. Well, in that case, they only have a cash flow yield of about 1% or about 1.5%. So those are the two extremes, and where you find yourself in the middle of what is the breakdown of how they spend money on content will determine whether the business is one that's great, whether it's one that's terrible, or whether it's just a business that's doing okay. Now, if we want to start figuring out what is the breakdown of how they spend money on content, we can first just look at how Netflix breaks it down. How does the founder-run management team decide how much is spent on maintenance and how much is spent on growth? Because they need to make that assessment in order to add an expense, which is the amortization of that content asset on their income statement. They need to reflect the decline in value of their content over time. And Netflix essentially says that their content they produce pretty much has no value. It has about 10% value to subscribers after 4 years. And when using that model, of the 18 billion spent on content, about 13 billion was required, essential spending, and about 5 billion was free cash flow that they simply reinvested back into the business. So for tax purposes and for financial statements, Netflix is essentially saying that, let's say last year, $18 billion spent, that most of it, about 2/3, was required spending that they could expense on the income statement, and about $5 billion was left over afterwards that could be reinvested back into the business, which they did reinvest back into new content. But there's actually a good reason to think that that breakdown from Netflix's management team is probably on the conservative side as well. The income statement doesn't just serve the purpose of showing shareholders how much profit is left over after the business. It's of course used in order to calculate how much tax a business pays. And if Netflix can argue that their content is worthless very, very soon, even though it continues to have value after a few years, then it means they can expense those content assets quickly, and it means they can lower their taxable income, lowering their taxes and ultimately making them a better business on a cash basis. Now, historically, this has not been an option for businesses. This is really something that's been born out of the internet age, because historically, businesses that had physical assets would be abiding by these very, very strict rules about how you depreciate those assets, depending on what asset it is, whether it's equipment, whether it's a building, whether it's something else that's a physical asset. But when it comes to intangible assets, it's incredibly difficult for a business or for anybody to figure out what those assets are actually worth after a few years. Like, how do you actually know what the value of a movie is? They might spend $50 million on it initially, but after 5 years, what is it worth? How do you put a number on what it's worth to the audience? And because it's so difficult to do that, it gives Netflix a lot of wiggle room to reduce their taxable income by saying that the content is worth less than it actually is. Now, if I've lost you in some of this, let me just give you the headlines. All of this is to say that the operating cash flow figure, which for Netflix is negative, is a massive underrepresentation of the actual free cash produced by the operations of the business. And on top of that, even the $5 billion that you see as the net income, the profit figure on the income statement, that I see a lot of people looking at and saying they've got $5 billion here, but cash flow is negative, so they're a bad business. But even that $5 billion is probably an underestimation of the actual free cash produced by the business, because they're incentivized to lower that as low as possible in order to lower their taxable income. And then there's Netflix's debt that we need to talk about. They're a liability-heavy company. Just looking at their balance sheet, they have long-term debt of $15.8 billion. They have about $8.2 billion in cash, so that gives them net debt of approximately $7.6 billion. And the typical ratios that you might run to assess the financial health for the business look terrible, right? You have a current ratio of 0.95 when it should be 1.5 to 2 or even higher, and a debt to equity ratio of 1.8 when it should be 1 or below, or even 0.5 or below is ultimately what I'm looking for. And then if you look at their cash flow, well, they're negative. So it looks like they have no ability to pay down that debt or even finance their interest payments. It looks like they're still in a position where they need to raise capital. But again, these surface level debt numbers don't really help us when looking at a business like Netflix. The entire purpose of looking at debt ratios is to assess how easily the business could cover their liabilities if there was weak economic conditions. But since Netflix is spending $18 billion on content, much of which, maybe not all of it, but maybe it's $5 billion at the very least, I would say, spending on extra spending on content that's not necessary, they actually do have quite a bit of free cash that they could use in order to cover their expenses if, say, interest rates rose or they needed to pay down their debts. To be specific, Netflix has about $6 billion of debt due in the next 5 years. Now, in 2021, Netflix had about $9 billion of content spending that was under contract, which essentially means that it's a liability. They were forced to make those payments. They'd already signed the contract to pay actors and producers and that sort of thing. But that leaves about $9 billion that they spent on content that was outside of contract. Meaning at the start of 2021, if the company wanted to, they could have stopped spending extra money on content and they could have paid down their 5 years worth of debt in like that. They could have just done it immediately. The reason why they didn't do it is because there's no reason for them to pay down the debt when they have the ability to do it easily anyway. And what is necessary right now for Netflix is to invest as much money as possible in content to maintain their competitive position, particularly as Disney Plus continues to grow at a rapid rate. So obviously this video isn't me telling you to go out and buy the stock. It's not as simple as just looking at cash flow in that way and looking at debt. There's obviously so many other things that we need to look at. We need to look at management's effectiveness. Are they actually good at investing within the business? Because they're spending $18 billion on content, but is that reaping a good enough reward? Are they generating enough return on invested capital out of that content spending? Do they actually have a sustainable competitive advantage, something protecting them from competition as it continues to increase? And then we can't just look at cash flow, we need to actually assess what we can get out of the business in the future, what is reasonable in terms of future cash flows, not just what they produced last year. But I'd love to hear your thoughts down in the comment section. I'm sure there'll be people who disagree with me on that, and that's fine. I'd love to have a discussion with you down there. As I said, hit subscribe if you want to stay up to date with content that I post in the future. But with that said, hope you guys have a great day. See you in the next one.